We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Alasdair Macleod, Head of Research at GoldMoney. Thanks for joining me today, Alasdair.
That's my pleasure, Tom.
It's great to have you back because, you've written a couple recent articles that really kind of take a step back and look at what could be, viewed as a very pivotal time in history. So why don't we just start by talking a little bit about the metal specifically? How do we break apart sentiment in the metal space, and what indicators do you look at to gauge sentiment?
I tend to look at the very, very big picture. I mean, most of the people, if you like, in sort of the gold bug community, sort of worry about, the day's performance or, what it's doing, between contract expiries on COMEX and all the rest of it. I mean, yeah, I do follow that. But the thing that really matters, I think, is a far bigger picture. And I think the way I'd encapsulate that is by saying that the world is splitting into two, which was the subject of one of the articles I think you might have been referring to, with Asia as a whole, dominated by Russia and China, both of whom have accumulated very substantial gold reserves, not declared as reserves necessarily, but nonetheless in government ownership. And so have virtually all those countries that are aligned with them. I mean, the members of the Eurasian Economic Union, for example, the BRICS have been doing that, and even these Eastern European countries, part of the EU, like Hungary and Poland, have been buying gold as well. So that is one side of it. The other side of it, of course, is the rest of us, NATO, if you like, America, UK, Europe, Australia, New Zealand, Canada. We've been doing absolutely nothing with gold at all. And so in a sense, I think that the future, if you like, if you want to look at the really big picture, you've got to look at the future of the Asian continent and their geopolitical strategy and its likely success compared with ours. So that, I think, is probably the one thing which I would really define as something tangible that we can argue about. And then, of course, there is also the background, and that is that we are very definitely on the beginnings of a bank credit contraction. Now, that is very, very serious, because if you look at GDP, you think GDP is the economic actions of everybody doing things which are included in the GDP. Well, in one sense, it is. But actually, the better way to look at it is the sum total of bank credit being deployed in the economy. So if you contract the amount of bank credit, then it doesn't matter what individuals are doing in the economy, basically GDP is going to go down. That's what we face. And the eventual consequences of that are bound to lead to more debasement of the fiat currencies and potentially their final destruction. And so in that context, you look at gold and silver, they are the only legal form of money. And this was stated by J.P. Morgan himself in front of Congress in 1912. He said, gold is money and all the rest is credit. Now, he wasn't, offering a matter of opinion. He was actually stating a legal fact, which is still true today. Mm-hmm. So if the currencies become debauched, which we're on a course for this to happen, unless suddenly by some miracle we get politicians who will actually draw a line in the sand and say, no, we're not going to print any more money. We're going to control the quantity of money, and we're going to ensure that there is some form of convertibility to stabilize its purchasing power. If that happens, wonderful. But I think that's like a snowball in hell's chance.
That's well put, Alasdair. And there's so much to pull apart there, but maybe let's start with that last part. Do you think that there actually is a case to be made for, if we stop printing, that we could actually reverse some of this damage? Or do you think that, maybe in the US dollars case, that the debt is simply too high at this point to really be manageable without some type of crisis or debasement to actually bring purchasing power back to that currency?
Well, it can be done, but it's not just monetary policy in isolation. You have to look at overall government policy and the degree to which government plays a part in the economy. That has to be reduced, and it needn't necessarily be reduced immediately, but if there is a firm plan to reduce it over time, then yes, it is perfectly possible. You must have the two things together, because the source of monetary inflation is budget deficits. I mean, I would rule out just printing for the hell of it, but it's basically budget deficits. That's the source of it. The problem, I think, in pursuing that route is that you also destabilize the existing financial system, which is based entirely on fiat currencies. You would, I think, drive out an awful lot of businesses in the economy, which rely on government subsidies, government help, government contracts, whatever it might be. So it's not a simple matter of just returning to sound money. And this is why I've always felt that this could only happen after a banking crisis severe enough to undermine the whole credibility of the government, therefore the credibility of their fiat currencies, and force the economic and political establishment actually to get real. There is no sign of that yet. I think we are on the verge of a crisis which will be triggered by the contraction of bank credit. I mean, when you look at the level of gearing or leverage, as I think the Americans prefer to call it, on bank balance sheets, I mean, in the Eurozone, it's over 20 times. In Japan, it is over 20 times. America is slightly more sensible at about 11.7 times, but that is still very rich indeed. Canada, I think, is about the same from memory, but you've only got 2 G-SIBs in there, which I track. So we can see that with bank balance sheets so highly leveraged, that with interest rates changing, I mean, the whole interest rate environment has changed. We've ended the long-term decline from 1980 to, well, last year. That's ended now. And we're now embarking on an interest rate course which is rising. I mean, you've only got to look at the rates of price inflation and current levels of interest rates to know that there is more in terms of interest rates rising ahead of us. So with that new environment, this brings in huge, great risks for the bankers, because they have been lending money to companies which simply can't afford a higher interest rate environment. So what do? They pull the plug on these companies. I mean, in many cases they will. And they will turn around to companies where they offer overdraft facilities and they'll say, we're withdrawing the overdraft facilities, or we're cutting it back, from $1 million to $500,000, or wherever it might be. So, there are those things they can do. That is going to have a major, major impact. And this is why it's so important to understand what GDP is. It's actually the total sum of bank credit circulating within the economy. That's it. It all comes back to bank credit. And if bank credit starts contracting, the economy is doomed. And that's basically what we're on the edge of.
Mm-hmm. So is there a scenario, Alasdair, where the higher interest rates that have triggered this risk-off environment start to actually work in gold's favor here?
This is an interesting one, because if you're a Keynesian or a macroeconomist or a conventional investor in today's markets, you would argue that higher interest rates impose a penalty on ownership of gold because it yields nothing. So therefore, this is bad for gold. But actually, I mean, it's a pretty stupid analysis, for the simple reason that actually the comparison you should be making between bullion and fiat currency is actually between bullion and cash, folding notes. I know we don't see so many of them nowadays, but that is where the comparison is. Neither pay interest. And the other thing to bear in mind is that the whole role of gold is actually as money, not as an investment. So this idea that, you've got an investment penalty for holding gold is complete rubbish. It doesn't apply. And as proof of this, when we went into the 1970s, I think I'm right in saying that the Fed funds rate was around about 6.5%, something like that, and gold was $35 an ounce. At the end of 1970s, we saw gold go up to $850 an ounce and Fed funds rate up at 19. So, is higher interest rates bad for gold? You're looking at the wrong thing. Mm-hmm. But having said that, I think that's what markets will do initially. I mean, if we have a banking crisis, we saw this also with the Lehman crisis. The first thing everybody did was they dashed for cash. They thought that was safety. And then they realized that actually the consequences of this are that the amount of debt is going to be, debt, credit, whatever, is the same thing. The amount of credit is going to be expanded, and that is going to dilute the purchasing power of the currency. And therefore, gold rose from, I think at the time, something like $680 to around about $1,900, $1,920. I would think on a banking crisis, which is probably no more than a month or two away. That sounds like a pretty extreme statement, but I think it could actually be that soon. The initial reaction could well be, I'm not saying that it will be, but it could well be for people to sell down gold, and particularly the people in the market who are short. They'd say, whoopee, we can recover our positions and sell it down. We all sort of think, oh dear, we ought to get out of gold and get into, US Treasury bills or something. Completely wrong. But that, I think, could well be the initial reaction. So I don't look at this, current level of gold and sort of think it's too cheap, too dear, whatever. No, that's investment talk. I'm just looking at it as money. I know that the current system is close to its eventual collapse. And under those circumstances, there is only one form of money that you should hold, and that is physical gold. Probably physical gold coin, where it is legal tender, and you can use it to buy what you want. I'm not talking about buying food and things like that, but if you want to buy assets on the cheap, like you might have salivated over that house sitting on the beach, which at the moment is priced at $3-4 million, you might get that for, I don't know, 5 ounces of gold. I mean, but it would probably be 5 gold eagles or whatever.
Mm-hmm. So, when we think about all these drivers for the gold price from a geopolitical lens, Alasdair, if the conflict in Ukraine, let's say, heats up more, or there's an escalation with China over Taiwan, could this drive more demand into gold even in the West?
Yeah, it could do. I think the drivers are probably slightly different. I mean, we're looking at currencies really in this context. I mean, the euro is in deep trouble. Of that, there is no doubt, and we might indeed talk about that. But the effect of it, as far as some fairly conservative, high net worth individuals in the European Union, particularly Germany, France, Italy, is that they would want out of the euro. Now, they've probably got enough dollars. They don't necessarily want more dollars, but particularly the older generation, they would be looking at protecting themselves with gold. And I think the same is probably true in Japan as well. I note that the yield on the 10-year JGB is back up at about 2.24%, 0.24%, which, bearing in mind that the Bank of Japan's sort of, if you like, Rubicon across it did not want yields to cross, was 0.25%. I mean, this is ridiculous. Anyway, 0.25%, we're very close to that. So watch the yen sail through 140 fairly soon. I mean, that to me looks quite likely. If you're a Japanese individual, then, gold is the obvious answer. So I think that a lot of the demand is going to come not from the sort of sources which we would normally track, sort of investment managers and this, that, and the other thing, maybe even, ETFs. But it's likely, I think, to come from high net worth individuals around the world realizing that the fiat gig is up.
You referred earlier to the this article that you wrote about the world splitting in two. So if you could, can you explain to us who Halford Mackinder is, and is Putin, maybe borrowing part of his strategy?
Yeah, I mean, we don't know for certain whether he's, sort of, if you like, a student of Mackinder. Mm-hmm. Halford Mackinder was, he was a sort of fairly interesting individual, and he lived at the turn of the 19th and 20th centuries. He was a geographer. He came up with his geopolitical story about Asia being the pivot, if you like, of the world, which he later called the world island. And his original paper was in, I think, 1905, round about then, 1903, 1905, something like that, presented to the Royal Geographical Society in London. And interestingly, at that time, the Prime Minister was Balfour, and Balfour was very interested in that pivot theory because he was concerned that Russia and Germany would get together. As it happened, that didn't really happen, because at the outbreak of World War I, we had Russia doing its own revolution. But certainly that was an interesting thing, which was echoed by the Ribbentrop Pact, Molotov-Ribbentrop Pact in the Second World War, when the Germans came to an understanding with the Russians. So it's this is a very, very interesting and important concept, that the world island, which basically is the bulk of Asia, rules the world, not the periphery. Now, the periphery for the last, I suppose, certainly since the First World War, has been effectively ruling the world. Probably even for a bit longer. I mean, we started with Britain with its empire, and then America really sort of took over from Britain, as it were. And that is still the case today. But when you look at the relative sizes of the two camps, if I can put it that way, well, the first camp being us, NATO, which is America, UK, EU, Turkey's even in there, but that's sitting on the slightly on the edge of this. You can also include Australia, Canada, New Zealand. Total population is roughly 20% of the world. On the other hand, if you look at the Asian powers and all their associates, so we're talking about China, Russia, Shanghai Cooperation Organization, the Eurasian Economic Union, and also BRICS, I calculated that that's 57% of the world's population, so more than twice our size. Now, this matters because Asia is rapidly industrializing. It's in an industrial revolution, which is really based mainly on communications, which China is basically funding. And so we've got the Silk Roads going across the whole of the Asian continent. You've got various spurs off it. You've got also the maritime Silk Roads extending China's influence outside Asia. So this is very much falling into the Mackinder model. And we have made some huge mistakes in not really appreciating what is going on. And I think the most recent one has been over our policies towards Russia. And it is quite clear to me that Putin's objective was not so much to gain all of Ukraine, though I'm sure if he just managed to walk in and take it over like that, he wouldn't have complained. I think it's far more that he wants to secure his Western boundaries, his Western borders. And in order to do that, he needs to get America out of Europe, or at least to get Europe to downgrade America's influence over it. And the way it's doing that, I mean, we fell into the trap, which he set. Our response over Ukraine was basically to sanction Russia, which basically cut us off from all the nasty oil, gas and coal, sort of carboniferous energy, which we're doing away with anyway. Yeah, so that's fine. But my goodness, look at what's happening to the prices. The other thing is that Putin has turned around. I mean, I think he pretty much worked all this out in advance because, these Russians can be good chess players, let's face it. And he's no slouch. And I think he concluded it would be quite likely. In fact, he would be very surprised if the West didn't impose sanctions against Russia. I mean, we know from past actions that Russia has been sanctioned through SWIFT, for example. That would be one thing. So what's his response? Well, it's quite simple. You want our oil, you want our gas, you pay in rubles. Meanwhile, what he has been doing is he's been making life easy for the World Island cohort by saying you can have oil, gas, coal, payable in your own currencies at a discount to global prices. And not only is he centering all this benefit, if you like, on the China, Russia, Shanghai Cooperation Organization cohort, but he's also got people like Saudi Arabia, who allegedly are thinking of joining BRICS. It doesn't make an awful lot of sense to me, but what does make sense is that from Saudi Arabia's point of view and the UAE's point of view, their future markets are not us. We're trying to do away with carbon fuels. It is Asia. So they are in there. And it was interesting to see Lavrov, Putin's foreign minister, briefing the Arab League in Cairo. He's making it absolutely clear to them what Russian policy on energy is. So, I'm afraid we've rather hung ourselves on this one. It's been a very, very stupid economic move. I mean, however you try and justify it politically, it's nuts, absolutely nuts. And the result is that this winter is going to be the hardest winter we have ever seen, both in terms of lack of fuel and also lack of food. So that's where we are. And meanwhile, okay, it's not going to be all roses for China. I mean, China has got its own property crisis. It's got that cyclical bank credit problem, if you like, in a way. Mm-hmm. It's destroying property capacity to try and ensure there is market for the new. Meanwhile, Russia is just going from strength to strength. I mean, I keep on reading in the Western press how doomed Russia is and how, they're going to come to heel and how the economy is collapsing. And, they come up with all these stories, but it is actually, it's completely made up. The Russians have a basic rate of income tax, flat rate, 13%. They have an economy which actually works pretty well. I'm not talking about necessarily at government level, but certainly, individuals can do reasonably well. Their main problem is the one that the Americans had back in the 1920s. And that is they've got, sort of, if you like, mafias. That, I think, is the problem. There's that lawlessness side, which means that ownership of property isn't protected as it should be by law. That is about the only real problem I can find with the Russian situation. Mm-hmm. In the West, we sort of bang on about, the lack of democracy and all the rest of it. Strong leaders, basically, there are two ways they can do it. They can either control their electorates through the democratic process, or they subvert the democratic process. And I'm afraid Putin is a strong leader, much as we may vilify him. So that's how I see it. And of course, as far as the dollar's hegemony is concerned, this is designed to remove the dollar's hegemony from the Asian continent. And it's important to understand that the way the banking system works is on a correspondent banking basis. So if someone in Ulaanbaatar, for example, wants to import, I don't know, let's say a Mercedes car from Germany, then the process is that they have to convert the euros into dollars before converting it into their own local currency. Now, the conversion into dollars means that the transaction is reflected in the US banking system. do you really want it? I mean, here you are, in this other half of the world, trying to get rid of the dollar's hegemony. Do you really want to have your transactions reflected in that system? And this is apart from the cost of transactions. No, and this is why they're looking at producing a new currency for trade settlement.
So has this conflict, we kind of touched on this a little bit, but has it really started to show the real power of Russia and who understands how important it is to be aligned with it? Is Turkey, a good example of this? You mentioned them earlier, and really just this how countries are starting to align with Russia.
Well, I think at national levels, this argument is actually pretty well understood. Mm. I don't know to what extent it's not understood in the West, because what we're told is one thing, what they know is a completely different thing. The thing that worries me about the West is that the intelligence services, I think, have an element of groupthink in their overall approach. So they don't necessarily understand this. And furthermore, our economic analysis is Keynesian and macroeconomic, which bears very little relation to economic reality. So we do have those problems. With respect to Turkey, I think Erdogan, he's trying to rebuild the, if you like, the Ottoman Empire in a sense. He's harking back to those glory days, because the Turkic people go from the Caspian Sea right into, right towards Mongolia. So you've got this sort of huge, great area, if you like, of historic Turkish influence. And there is no doubt that Erdogan, sort of wants to retain and build on that. And so he's got this relationship. Originally, what he wanted to do was to join the European Union. And part of that, it was really an extension of the early days before he was ever on the political scene. Turkey was very much part of NATO as well. So, Turkey was looking very much to the West, but the European Union turned around and said no, principally because France vetoed it. I mean, bear in mind that France has quite a problem with its Muslim population. It's always been very, very slow at integrating in France. I mean, it doesn't mind Muslims abroad in a sense, but on its own domestic patch, you get ghettos in Paris and so on. So this is very much a country which did not want to see yet more Muslims come into the European Union. So that rather forced the Turks to start to look towards Russia and the East, and that's basically what's happening. So at the moment, yes, Turkey is a member of NATO, but it is very much sitting on the fence. It realizes what's going on. It is, I think, an associate of the Shanghai Cooperation Organization, so not a full member, but you can see, there's just more and more evidence that they're sort of literally sitting on the fence with this. They can't really chuck out NATO, but increasingly their future lies, I think, within Asia.
Mm-hmm. And Alasdair, you had mentioned as well some of the problems that China seems to be having, with the development and this property crisis. So could this start to cause real problems within their banking system? We've recently seen that people's bank accounts were seized in China. So could this have just, maybe been the tip of the proverbial iceberg in China?
Well, it is. I mean, obviously, it is creating problems, and you're right in saying that there have been bank runs. But the structure of the Chinese banking system is that it is absolutely dominated by the state-owned banks, and the executives in these state-owned banks are effectively functionaries. They're not acting for profit-seeking shareholders. They are told by the Communist Party what their lending policies are. In terms of asset to equity ratios, they're about on par with America, in fact. So they're not extreme in the sense that Europe and Japan are. There is, I suppose, in that sense, room for further credit expansion on direction by the Communist Party. The private banks where the failures exist have been, they are relatively minor in the scheme of the whole thing. So what the Communist Party has been doing is literally trying to stop runs on the bank by preventing people going to, try and withdraw deposits. The property crisis itself is significant. I think there've been something like 30 odd failures, or I can't remember the number. I mean, quite a large number of failures in international markets, bonds backing developers in international markets. And that has created enormous problems. You have people who have, agreed to buy off-plan properties, and they pay up front, and it's paid up front in the form of mortgages. And they're no longer paying the mortgages because they say, well, if the developer's going bust, there's no point in paying the mortgage. So you can see that the crisis is quite a serious one. China is responding to it by demolishing quite a lot of existing unsold property to create the new, as it were. I mean, this is a wonderful sort of Keynesian thing, Good thing about a war is it destroys things and you can benefit from the rebuilding afterwards. That's the sort of rubbish that Keynesian policies come up with, and China is doing pretty much that. I think if you look sort of beyond this, I'm sure that because of the structure of the banking system and the fact that the banks are already owned by the state, that they can control the credit side of this. And I think the way I would look at the demand for property side is, I think long-term demand for property in China is going to increase and increase. It's just that they've got ahead of themselves. So I think they'll probably ride out this cycle. I don't see it really destroying the economy in the wider sense, in the way in which it would say. I mean, when we saw the failure of Lehman at that time, I don't think it would be as bad as that. But China has also got the problem that if the West collapses, then it does an awful lot of trade with the West, and so that's something which it would also have to ride.
Mm-hmm. So, Alasdair, you again, one of those big, let's say, topics that you mentioned at the beginning here. How will Europe deal with its lack of energy this winter? Could we see European governments end up, sending checks to parts of the population to help with heating costs and energy costs, which would obviously serve to push inflation higher?
Well, the problem with going down that route is that the governments don't have a central bank, to do that. What they have is a centralized currency, and they depend on their funding from the ECB, basically. So they can't really do that directly. They've got a real problem, and I just have this mental image of Putin sitting there, tapping his fingers, waiting. When are you going to wise up, guys? Get rid of those damn Yanks, and let's start talking. That's and that pressure is beginning to work. I mean, it's fascinating. I was reading one of our main newspapers here, the Daily Telegraph, this morning, and saying this is the 6-month anniversary of the invasion of Ukraine. It's also coming up to the annual parade thingy and all the rest of it. And Putin's going to want this. Putin's going to want it. It's absolute nonsense, complete nonsense. But one of the writers was saying that the European nations need to strengthen their resolve. They need to stay together. They're signs that the resolve is cracking. That's got to be stopped. So, looking at it from the other end of the telescope, I would say that Putin's policy is working. It's going to get a hell of a lot worse for the Europeans and us, incidentally. I mean, there was a next day electricity prices. I saw a chart of all the next day European prices, electricity prices yesterday. And we were at the top of the list.
And it's a very dramatic chart.
Yeah, very dramatic. I mean, wow. So even if we come to an accommodation with Russia, there is going to be an energy crisis. But having said that, if we come to an agreement with Russia very quickly, then it will actually soften the blow hugely and is very, very necessary. But we'll still have the food problem, because food is something that's got to happen in advance. And I mean, you can just turn on the taps again. I understand that one of the big pipelines is down for unscheduled maintenance. Ho, ho, ho. So you can see that Putin is still playing these games. He's still putting pressure on Europe. He's making the Europeans' lives and ours extremely difficult. And from his point of view, it's just a question of how long will it take for us to see sense? And he's not going to give in easily. I mean, he's not going to sit down and have long chats, with, NATO and this and that and all the rest of it. He's not going to do that. He's going to say, no, come on. It's quite simple. I want to secure my border. What do you mean by that? Well, America, go away. He wants the European Union to break the influence that America has over it. That is his true objective. And I can't see really that the Europeans are in a position to resist that.
Mm-hmm. And you'd earlier mentioned as well that we could see this banking crisis unfold, and it could be as soon as a month or two away. Does this somehow coincide with, this seasonal demand pickup in energy as well?
I think it's there's a degree of coincidence, but having said that, the losses for the Eurozone banks are actually quite significant because all their Russian and Ukrainian interests have basically been shut down. Boom. So that's loss. No, I think the banking crisis is a deeper thing. It's more about the turn in the long-term trend of interest rates. They've declined since 1980, down to minus figures in many cases, zero in the case of the United States. And now they're on the rise. And of course, everybody's got caught out by it. I mean, from central banks downwards. I don't know if you noticed, but when you look at government forecasts of what inflation, consumer price inflation is going to be, they're saying, oh, well, it'll sort of return to 2%. And where they were saying it was going to return to 2% at the end of this year, then now, they moved that out to sometime in 2023. And now they're talking about early 2024. They just don't understand actually what has happened. It is a turn in the whole thing. It is the destruction of the whole financial system. How? Through the contraction of bank credit due to rising interest rates. Those are the two things that are working together to destroy us. And I think the fact that Russia has had a pop at us over energy is coincidence. I don't see that Putin took this as I don't think he had some sort of sort of secret information about our situation which made him act. I mean, in my experience, politicians and their advisors aren't as smart as that.
At least maybe not in the West.
No, I mean anywhere they really are not. Mm-hmm. They're always, the thing about politicians is they will always pursue their vested interests. And really, for 150 years, vested interests have not been the people's vested interests. It's always the government's vested interests. I mean, you do get exceptions. I mean, when Deng took over in China, he understood the people's vested interests, and everything he did was to further the people's vested interests. In this country, we had it. It first really came after the Napoleonic Wars, sort of 1817, 1818, 19. And 1816, the sovereign, which was a pound, it was, a pound coin, that was first issued, and it became legal tender from 1817 onwards. And it is still legal tender, incidentally. The difference is that, they're now 350 paper pounds to one gold pound. It gives you an idea as to what the hell's happened to the currency. So, I just don't see, apart from these just very few instances, that politicians actually do understand how to further their people's interests. It's always furthering the government's interests.
So as we're talking about currencies, the euro recently fell below par with the dollar. So from your perspective, was this a significant level, or is the trend the more important piece to this?
I think the trend is by far the more important piece, though obviously, it falls below 1. And I think particularly when it gets below 99 cents, everybody will say, it's just on 1. You sort of don't worry too much. Yeah, it'll get headlines, but it's the trend that matters, because bear in mind that the whole euro system has a huge, great problem with rising bond yields. They have, through QE, the ECB and also the national central banks between them have accumulated an enormous amount of bonds. And obviously, as yields rise, values fall, and they've got losses, mark-to-mark losses. And those mark-to-mark losses are now very, very significant. They wipe out the whole of the euro system's capital several times over. And that's even after this sort of slight consolidation and downward move in bond yields. And I mean, I know how to recapitalize a central bank. That's very, very easy. We've done this in history. Basically, what happens is that you go along to your government and you say, we will lend you some money. That will appear on our balance sheet as an asset. We want you to put that money back in, or rather, you don't have to do anything, because what we'll do is we'll make it appear on the other side of our balance sheet as a liability to you. But instead of it being ranked under deposits, we'll have it ranked under capital. So that's the way you recapitalize a central bank. It's extremely easy to do. Mm-hmm. But what do you do with a system whereby the European Central Bank has no government to turn to? It doesn't. Its shareholders are the other national central banks, who are equally in the same position. Now, they can turn around to their governments. Look at the situation for the German central bank, the Bundesbank. It turns around and says, what I've just said. What we'll do is we'll, create an asset which will be a loan, but instead of it putting it in as a deposit, what we'll do is we'll put it in as capital. So that's easy to do, but it requires legislation. So you can see that the politicians on the Bundestag will be saying, well, hold on a minute. You are owed 1.2 trillion euros through the Target 2 system. What's all that about? Please explain. And I really think that the explanation of all that will be, because they'll call in experts, and I pretty well know which experts they'll call in. And the answer basically is that the whole effing system is completely rotten, top to bottom. Mm-hmm. So will the Bundesbank get the money to recapitalize itself? Maybe, but it won't get the money to recapitalize or the permission to recapitalize the ECB. So what I can see is not just the commercial banks being so highly leveraged that they are bound to collapse in a worldwide bank credit contraction, but also the central banking system, the euro system itself, is bust. Now, your original question is, how do you see the trend in the euro? Well, I think that answers the question. I wouldn't hold it at all. And we've got a problem in London because all the commercial banking, interbank settlement is done in London, in euros. So euro collapses, the banks collapse. It's hard to see how we can see our way through that. Mm-hmm. Not good.
And you and I, of course, have spoken about the ramifications and implementation of the Basel III system there. So the other day I spoke with Tom Luongo, and he was mentioning that it was important for the banks to have made this move, let's say specifically with their gold assets. So do you think that this was intentional at that time?
I'm not sure I would quite discuss it in those terms. I mean, the problem, I think what set this Basel III thing off was the failure of AIG, because AIG, big insurance company, it just looked at the creation of over-the-counter derivatives as being an extension of the insurance business. And it got involved with the sort of these securitized mortgages, and of course, when all that started going wrong, etc., and they then got downgraded by the credit agencies, which triggered various things, like particularly AIG actually had to put up sort of collateral and so on. And so the whole thing started falling apart, and the Fed, I think, had to bail them out to the tune of about $85 billion, which I know is not a lot today, but then it was a hell of a lot of money. So that, I think, was why Basel III really started. They recognized that there was a huge problem with various categories of banking asset, which they hadn't really addressed before. And derivatives were one of these problems, and it was central to the whole thing. So when they set up the net stable funding ratio, they looked at derivatives. And in my opinion, they've actually screwed it up badly because they haven't gone far enough. What they've said with derivatives is that if a bank has a net liability on its derivative book, in other words, you take all the positives and all the negatives, lump them together, if that's a minus figure, then that will impact on your nets on your net stable funding. So you can't use your net stable funding to fund that liability. That's the first thing. If, on the other hand, you get all these derivatives and you put them all together and you end up with a positive number, then that affects the other side of the equation. Basically, it's a discouragement, if you like, to having a significant net position in these derivatives. And they also turned around with gold and said, well, when it comes to the required stable funding, then there's a haircut of 85% on that, which upset the LBMA. But I know someone who was in one of the original meetings between the LBMA and the Basel Committee, and they just laughed at the LBMA. I mean, the LBMA were just trying to pull the wool over their eyes. Where this goes wrong is that by lumping derivatives together to produce, a net positive or a net minus, you're ignoring the fact that 99% of each derivative is in itself credit, because it is a commitment. Unless you sell that commitment, if you can sell it, because in an over-the-counter market, you can't necessarily sell it. It is a commitment to take an action for the full amount at some stage in the future. That is the whole point about an over-the-counter derivatives. Look at it as a forward transaction, if you like. So you have got, I was looking at the Bank of International Settlement figures, and we're talking about $610 trillion equivalent of these derivatives, which are not being properly included on bank balance sheets to reflect these future liabilities. So the whole situation, the whole of the Basel III regulations around the net stable funding ratio, to my mind, it's not addressing the elephant in the room. Mm-hmm. If you get just literally one counterparty going wrong in the over-the-counter derivatives, there can be a chain reaction, taking out a whole load of other derivatives. This is actually very, very concerning. And what I would say is that if I'm right and we are on the verge of significant contraction in the amount of outstanding bank credit, then the effect on the derivatives market is going to be very substantial. But there is, I think there are two effects on this. I think the first is that when it comes to market making, which is part of the whole thing, because you can't just look at derivatives, you've got to look at the market making bit underneath. I think that banks will tend to withdraw from market making because they will see this as potential risk. They see that, even under the Basel III net stable funding ratio, they will want to reduce their derivative liabilities. And I think the smarter bankers will see just what I've said, that actually the liabilities are far greater than are admitted in the Basel III regulations. So I think they'll be trying to cut back on this. And now, the effect on financial securities like bonds and equities, I think, are probably going to be negative. And that is on top of the effect from rising interest rates. So that's not good. But when it comes to commodities, it's a very different situation. I was looking at the numbers for over-the-counter gold. These are the last figures that the Bank of International Settlements actually have. And what we're looking at is the paper equivalent of over 11,500 tons of gold is outstanding. I'm not talking turnover, I'm talking about outstanding. So that is effectively synthetic gold. Now, let's look at a black and white situation. If, let us say, that was stopped completely, then there would be holders of synthetic gold to the tune of 11,500 tons who would no longer have gold. So you can see that it creates demand for the real stuff. Mm-hmm. It reverses the policy which Peter Hambro was saying. He produced a very interesting little article 6 weeks ago, I think it was, saying how, when he was in the bullion market going way back into the 1970s, it was clear that the Bank of International Settlements was coordinating with central banks, and I think particularly the exchange stabilization funds, which are probably more a treasury function than a central bank function, but nonetheless is run out of central banks usually, to suppress the price of gold by increasing the quantity of paper gold. And that was really how the London bullion market, the LBMA, really took off. And it was done, the way it worked was quite simple. A bullion bank like Macata Goldsmith or someone like that would turn around and say to a customer, well, if you want to actually hold your gold, that's going to cost you. On the other hand, we can offer you a gold account completely free of any charges. This is an unallocated gold account. And so that was the start of that. What we're looking at is the reversal of this. But it's not just gold, silver, platinum group metals. It's also oil contracts. It's also copper contracts. It's also contracts in anything, any commodity, which is covered in over-the-counter or indeed regulated markets, because regulated markets have exactly the same dynamics behind them. So what I think the consequences of a contracting derivative world, and this is assuming that there is no crisis created by it, which is a very optimistic assumption, I have to tell you. The consequences of that, I think, are negative for equities and bonds, but positive for commodities, for anything tangible, if you like.
Mm-hmm. And, just to, I guess, wrap up the commodity piece here, we've seen a little bit of a pause in the rise of commodity prices. Is it possible that this seasonal spike in energy demand starts to push that back up?
Yeah, I'm sure. But, there's so many factors behind this. I think that they're probably bigger factors. We saw Saudi Arabia saying, well, if the price of oil goes any lower, we'll withhold production from the market. Mm-hmm. This is, I think, the Saudi energy minister. Now, this is entirely in line with Russia's management of the oil price outside their Asian fiefdom. It's in line with what I'm sure Lavrov was telling them in Cairo, the Arab League in Cairo. So, yeah, that doesn't surprise me. But I think also that the situation really with Europe and its lack of carbon fuel, I think it's going to be the bigger driver. And I think as we get closer to the winter, I would see these energy prices beginning to rise. Whether we react to new conflicts in Ukraine or whatever, I think in a sense is immaterial. The underlying problem, I think, is that Europe has got to give in. And that's going to be politically very difficult for it to do. But it's got to be pushed to the point where it does. And that's the fight. And that's what's going to drive energy prices.
Mm-hmm. Well, Alasdair, I think that's a fairly good place. Maybe not so optimistic, but a good place to kind of wrap up today's conversation. Is there anything else you think we should touch on before we do?
I think there's probably quite enough gloom and doom for for anyone. I mean, I'd love to come out with something more positive, but I have to tell it as it is. Mm-hmm. And all I can say, I mean, obviously we don't give investment advice, but I would strongly suggest that anyone who hasn't done so looks to take this opportunity of the Keynesian world driving down the price of gold and silver to look at just getting a bit of protection, hoard a bit of protection. You may not need it, but on the other hand, if you haven't got it and you need it, you will regret not having done so. And that's what we do at GoldMoney. GoldMoney.com. Go and have a look.
And of course, you're an excellent follow on Twitter as well, at Macleod Finance. Alasdair, I want to thank you so much for your time today and all of the knowledge you have to share with us.
That's very much my pleasure, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.